Ali, lovely to see you today. Obviously, I'm James McGregor. I'm the director of P10 Financial Group, but my role there is head up the capital team, capital debt advisory team. Ali, look, why don't you introduce yourself? Just to give a bit of an understanding to our market about who you are.
I'm Ali Varna. I head up the national capital markets team at Carter Jonas. I've been here for 4 years now, and my role is to work with investors, a range of investors from UK institutional mostly, but also overseas investors, multifamily offices, family offices, and some private investors in the UK.
So within that role, within the capital markets team, where do you find, or what is the market that you're covering the most at the moment?
At the most of my time, we are cross-sector, but I find most of my time being spent on offices both in the southeast, but also in the regions.
That's interesting because it's been a bit of carnage for the office space over sort of the last 5 years, so to speak.
Yes, it's been a really challenging time, particularly in the secondary regional market. I think over the last 2 years has been particularly challenging because everything just ground to a halt. People didn't know where pricing was. I think we're through that now. I think we are through that, subject to what's happening in the wider world, but I think we're at a turning point in the market.
Probably about a year ago, you'd say, just all of the capital came flooding back again. Would that be fair to say?
Yeah, I think we're in a very different place to where we were this time last year. This time last year, transaction volumes were down, and towards the end of the year, it started to pick up in the West End and in the city. And I think it's where people began to find where the bottom pricing was, and some realisation of actually where is the market. And as people started to stabilise, there more entrants had more entrants into the market, felt more comfortable putting capital in.
And I guess another factor that helped that is rates reducing over the last 18 months.
Yeah, it's when the rates were going up, it's very difficult to build a business model based on rates rising. So not much of a surprise, but deals stalled. And as soon as they started coming down, all of a sudden the view was very different, and the stock we had out in the market, all of a sudden was getting interest, and viewings increased. We had some sensible offers in, and deals started going under offer towards the end of last year.
And then coming back to the regional sector that you've sort of said has now sort of started finding its price points again. And
in the regions, it's quite interesting. Everything follows, the core market. So let's say London, and it spreads out into the regions after that. That's always happened. But what we've seen in the regions are it's a case of you've got three almost submarkets and offices. You've got those that have, those that don't have, and those assets where actually the only way out is to reposition it. So those that have are the ones that have got all the ESG credentials. You've got the right floor plates, you've got the right internship facilities, which makes occupiers want to be in that building. And once you've got a building where tenants want to go into it, the investment follows. I think where it gets challenging is where you've got offices which are more difficult to refurbish and get into that state. And that's where there becomes a big difference between those that have the right elements and those that don't have the right elements. But what we are seeing is, whilst some of the institutions have sold their office investments, they retained the ones which they felt, some of them retained the ones which they felt were core.
Yeah, like the best-in-class asset again.
And actually that's proven to be a clever thing to do, because actually they're holding on to sensible assets now, and they are seeing rental growth. When they're underwriting it, the things that are important to them are stability of income, strength of the income.
So I guess we're talking now in general about the office market. Are you starting to see yield compression in these assets over the last year or so?
I would say probably since the budget at the end of the last year, all of a sudden we have seen a shift in how people are looking at offices with income. I'll give you an example. We have bid on an office in the Thames Valley, which is grade A office building, built within the last 15 years. ESG credentials are all where it needs to be. And before we realised it, as we went into the first part of this year, the yield was compressing into the sevens, into the mid to low sevens. It's still under offer at the moment, but that to me says that that wasn't happening a year ago. and this to me says that there is a change happening in the market, and I expect that to continue.
What is it that's driving this flood back to the office market, I guess?
I think what's driving the investors wanting to get into the office is the fact that occupiers are wanting to get back into offices. And I think, generally speaking, the more people I speak to, more people are spending more time in the office than they are at home.
Where do you believe the opportunities are right now?
I think in the regions, there are some really interesting deals out there where the values have come down to a level where having an underwrite for an alternative use is quite interesting. So it may be that your unexpired term means that you can't get in and reposition it straight away, but actually if you're buying it at a sensible level today, if your rents are sensible and there's a strong argument for rental growth, we are still getting to a position where we're trying to find out where the pricing is, and you can try and get a spot yield with values on it, and you can still have quite a wild variance, anywhere between 8 to 13%. And you can argue both ways, which one's right, which one's wrong. And what we found is that sometimes the price paid for a property might not necessarily reflect the quality of that building or the tenants or the quality of the location, but perhaps the nature of who's selling and why they need to sell and how quickly they need to sell.
One of our clients recently acquired an asset in the Thames Valley at a 15% yield. That's probably not the true value of that asset, but the circumstances allowed them to acquire at that really high yield. Also, from a banking perspective, we're seeing even like the high street banks come back to the investment market, which they hadn't been there for 10 years. And when you're seeing that jump back in, you know the fundamentals of that asset class is getting stronger and stronger.
Some of my investors are, and some of our investors are, once again adopting a let's wait and see approach.
When these little situations are happening, like you said, Brexit, XYZ, they've always shown us they've been a great buying opportunity.
Yeah.
Like, for example, when the market is panicking and withdrawing, sure, that I've always found that's a great time to negotiate.
And part of the reason for the attractiveness of being in the UK, particularly at the moment, is I think investors have got quite good at absorbing shocks. Deals are still happening. Deals aren't being sold 60p in the pound.
Yeah.
I've still got people looking at the assets which we're selling. I think we've proven ourselves on the world stage to be quite a safe and stable place to be.
Do you think we're going to start seeing more inflows from places like Middle East with what's going on?
Yeah, I think this has been happening for the last 2 years, where we've been seeing more overseas interest, particularly in the US, also the Middle East, and also other parts of Asia. But actually, from a price perspective in the offices, it was looking pretty cheap.
Good value.
It was looking really, really good value. And because of that, it was looking very attractive to other parts of the world. I'm expecting quite considerable rental growth in the right buildings and the right locations, which have got the right ESG credentials. And therefore, I would expect to see more yield compression in buildings like that. I think if you still have the right office with the right credentials and the right tenant lineup, I think we probably will see some yield compression. Maybe not to the degree that I thought we would a few months ago.
Yeah.
But I expect there to be strong performance in that primer end of the market, and that goes to the regions as well as the West End and the city.
Brilliant.